right. So welcome this evening to Ryan Fleming from JGS Insurance. He is going to do our interactive discussion on community association insurance. This evening, we do have our New Jersey group, but I think that a lot of this could also be applicable to other states as well. So Ryan, I will turn it over to you. And yeah, thank you so much for joining us.
Sure. Yeah, thanks for having me. So as Julia said, my name is Ryan Fleming. I've been in this industry for longer than I'd like to admit, about 20 years doing this. I run the habitational department at JGS Insurance. We are, our location is in Homedale, New Jersey, although we're all over the place. We are part of a bigger group called the Baldwin Risk Partners, which is a publicly traded company. All that fanciness doesn't mean too much for the community association world. That's where I specialize. That's the only thing that I do. It's the only thing I've done for about 20 years now. And it's very specific. It has very specific needs. So with that being said, what we're experiencing right now requires the most amount of education that I think that the industry has needed for the last 20 years. We're in a market that is almost uncontrollable, and it takes a massive amount of planning and a massive amount of thought and education to figure out how to handle ourselves in what is probably one of the worst insurance markets that I've ever seen. I don't know if you guys have experienced the same kind of thing. Renewals are almost unpredictable. Yeah. So yeah. So I'll get into just lightly touch on what's causing this situation, so everybody can understand where it's all coming from, so they don't think that it's just magic, that it's just happening, that prices are going crazy. So it's what's called a hard market. That's the insurance term for what's happening right now. A hard market. That means prices are going up. Prices are going up and coverages are being reduced. By coverages being reduced, I mean some carriers are leaving the marketplace. Other carriers are saying we're still here, but we're not willing to offer limits like we used to offer before. So like high umbrella policy limits like we've seen before, those just don't exist. The limits are being reduced and the coverage prices are going through the roof. So that's what a hard market is. Carriers are less willing to negotiate. They're more fearful, and they start to do what's called underwrite to a profit. So we are in a hard market. We've been in that hard market for about 18 quarters in a row. They count it by quarters because each quarter the carriers are reevaluating what's going on in the marketplace, meaning how many claims dollars are paid out, where are our investments being productive, or where are we losing our money, how many natural disasters have occurred. They take a look at that quarterly and they say, do we need to revise the way we do business? And that's called actuarial data. I'm giving you all the insurance terms, but you don't have to remember any of them. There's no quiz. But just understand there's a concept here. There's a hard market and it's consistently indicating that it's going to stay. So it's been here for 18 quarters. That's a longer hard market than we've seen. I can't tell you how long. I can only tell you in the last 20 years. That's a longer hard market than we've ever seen. Typically, it's a 2-year hard market, kind of levels off, and it comes down to what's called a soft market. When carriers start to enter, everybody starts to drop prices, competition is heavy. That's our favorite market. That's everybody's favorite market, because now all of a sudden everybody's happy about their renewals. So it's my favorite market for sure. As typically the market will soften and things will get a little better, we're not in that yet. So all the indicators to all the carriers say we're going to need to continue to harden our market, and you guys are seeing it elsewhere. So take insurance off the table. Let's look at what's happening around the globe. So around the globe, I've got a couple. I'm not going to go bore you guys with all the slides, but I'll put up a couple of them. Let me see. I only want to bring up the ones that make any sense. It's a lot of words. You guys are going to get bored by that. So I can just talk about it. All right. So what's happening around the world is we had 95 natural disasters in the last couple of years. 95 natural disasters. We're not talking about just in Florida. We're talking about everywhere. And the insurance carriers that pay for claims in Florida are the same ones that pay for claims in California, and the same ones that pay for claims, guess where? New Jersey. They're no different. They pull from the same pot. So when they look at their data that says, how many claims did we pay out? We're not talking about community association insurance and how bad the community association insurance is for the carriers. We're talking about claim dollars, whether it's fire, Texas freeze, a hurricane, wind, Ida. Ida was a bad one, believe it or not. Ida crushed some communities. I don't know if anybody on the call got hit with that Ida issue, but it was a bad one. So anyway, those claim dollars, they start to pile up, and the underwriters have to then re-underwrite. The underwriters have to say, well, we didn't charge enough in order to pay for these claims. We're paying for more than we charge. They don't take a look at how many dollars have been paid to them over the years. They just look at the recent numbers, and they say, we don't like to ever pay out more than we collect. So let's make sure that we underwrite to a profit. You heard me say that a little bit earlier. So that's where you're getting these indicators. Claims are saying we're going to need to get more premium. All right. So that's one thing that's happening. Next thing that's happening outside of the insurance world that has an effect is no one has any products to do anything. You can't buy a car. You can't order a Tesla anymore. You can't build anything in your house. Try to get kitchen cabinets. We did that during the pandemic. That was ridiculous. That was like a year. We had to wait like a year for kitchen cabinets. What happened across the globe is everybody being home and interest rates that were, I think we can all agree, everybody on this call probably refinanced in the last 2 years, right? Because interest rates were so low. So when you refinance across the globe, you take some of that money out and you do some home improvement projects across the globe. So everybody did it on a large scale. So now all of a sudden that piece of plywood that was $18 at Home Depot is now $81 at Home Depot. And those are actual numbers from Home Depot. You would think, well, what does that have to do with insurance? Well, after a claim occurs, where do they get the building products? And how long do we have to wait for those building products? Couple that with the fact that you can't hire anybody to save your life because everybody's sitting at home collecting. So they don't want to work. So you have to pay them more to come in. So your cost for staffing increased as a general contractor. So did your building supplies and your reduction in availability. So now all of that comes together and the carriers say, wait a second, we only had this building insured for, let's just make up a number, $30 million. But if we were to rebuild this building right now, it would cost us 50, maybe more. So the carriers are saying, not only do we have to change our underwriting guidelines and charge more money, now we have to base our underwriting guidelines on a bigger figure, on a more expensive structure. The community did nothing wrong. The community's probably doing everything right. New roof, everything is taken care of. Our sidewalks are all ground down. Everything is being done right? However, building products go through the roof. We now have to suffer the consequence of that. And carriers are reacting that way. So these things continue to happen. The carriers are saying, can we just get some indicator that tells us we can stop increasing prices? All right, so let's look at the stock market. Anybody got any money in the stock market? All right. Okay. Well, you used to have money in the stock market. Now you no longer have money in the stock market. Me either. But anyway, that's an indicator of bigger investments. And carriers, there's two places for them to make money. One is underwriting to a profit, like we talked about. The other place to make money is by investing your premium dollars and trying to get a return on those premium dollars without paying out for claims. So there should be enough where they can invest, make some money in the market, and not pay all those profits out for claims. So the two places that they have to make money, one is underwriting, they're getting crushed by claims. The other one is in the market, they're getting crushed in the market. So there's another situation. There's another situation that's saying, okay, we have to harden this market even more. So yep, claims, reconstruction costs, and lack of an investment availability, all of those indicators are saying, carriers, increase your prices. And now we are stuck having to deal with the outcome of that. And that's the market that we're in. Does everybody follow me so far?
Yeah, definitely. So with all that being said, Ryan, where do you predict us going in the next few years?
So yeah, man, I'm like the bearer of bad news here. So, but listen, we got to know about it, right? We have to know about it. I don't see prices coming down at least for another 12 months. So if our renewal is happening within the next 12 months, we're going to need to understand that this trend is going to continue. I think the worst increases that we're going to experience, maybe we've already seen those. That's my gut reaction, because the carriers definitely have knee-jerk reactions to everything that's happening. And I don't want to say this, knock on wood, but what else could go wrong? So.
Well, I mean, we can't predict more natural disasters, I guess, unfortunately. Not that I like to think that way, but that's would be my thing that we can't really project is, what if we get Ida 2 and that's just keeps occurring and we just get more and more of that. So,
yeah.
But anyway, so you think that, we're headed trending still upwards, but hopefully leveling off, and, all of those factors kind of take part. And I know you're saying too, that the market as a whole, like not just statewide, it's, national basically, as far as these carriers go. But I'm sure that the association itself, their loss history plays a significant part in that as well, right?
It does, yeah. Yeah. So, and you're saying nationally, but I got to tell you, even what's happening in Ukraine, one of the larger insurers there in the Ukraine is Lloyd's of London. They are currently paying out their insurance policies. They write terrorism all over the world, right? So they're paying out on all those policies right now. Lloyd's of London being the largest insurer there ever was, and the beginning of all things insurance, of course. They're going to be the leader in saying this is the way that the market's going to have to go, and that's not looking well either. So your question is, okay, the association's loss history, does that come into play? And yes, it absolutely does. That brings us to, well, what is it that we need to do as a community to deal with this upcoming issue? Well, the point is trying to find savings at your renewal is really, it's kind of like a unicorn. That's going to be a tough thing to do. If you find some savings, it probably means that you were improperly insured before. So if you're properly insured, which most communities do find themselves properly insured, well, there isn't too much savings available in the marketplace. So the key here is to try to find ourselves in the bottom of the market pricing. So how do we maintain the best in class rate that carriers are willing to charge? And that's what comes to, we bring up loss history, or the condition of our community, or the things that the projects we're putting in place in order to maintain ourselves or modify our governing docs to work for us, not against us. That's a big one. Mandatory burst resistant hoses in our units, mandatory dryer vent cleaning, requiring people to have their own coverage so that there's not just one carrier that's the associations that's involved in a claim. I mean, you name it, there's a million things that you can do.
So out of some of the suggestions you just mentioned, right? So burst resistant washing machine hoses, dryer vent cleanings, etc. So let's just say, let's just give an example, right? We're an association, and let's just say our renewal is, let's just say in December. If we implement that now, will it be effective, or are we still like kind of a year out before that kind of affects if we can see any sort of savings or anything with that, or insurability at all? Because I know sometimes it counteracts if you have a claim and then sometimes you put those policies or resolutions into place, you can kind of say, well, we had that claim, but here's what we did to counteract that, or here's what we're doing proactively to prevent something like this.
Yeah, Julie, you're nailing it. If you are currently experiencing problems, the immediate fixes are pretty evident. So if you're currently experiencing water damage issues, and we can say, hey, listen, we're gonna put in mandatory burst resistant hoses, or we're finding you, well, that's an immediate fix, and I think that's going to have an immediate effect on your upcoming renewal. However, I mean, those are great to have. Those are great situations to have where you're like, oh, I see a way to fix this, and we've got the time to implement it. So that's a great scenario. In a lot of scenarios, communities kind of are doing the right thing. and the loss history is not so crazy. However, they're still getting pounded with that increase, right? Or they're still getting hit with the increase without a glaring issue that they can fix. So in that case, I think that's where communities have to take a step back from what they're looking at, which typically a community will take a look at their renewal in a 60-day window. And they'll say, all right, let's address insurance, our largest line item, within a 60-day window. We're going to wake up, address it within 60 days. Hopefully it works out, renew our coverage, and then we're going to go back to sleep and not talk about it for another year. So that's usually not going to work out in your benefit when you're talking about long-term insurance costs. It's the largest line item on most communities' budget. So I would say for communities that are doing things right, that want to deal with this kind of market better, you want to zoom out and you want to say, all right, we've got, the carriers look at us in a 5-year window. They take a look back 5 years worth of history. That's what they say. Because what they're trying to develop is what's called a loss ratio. They're trying to say in 5 years, X amount of, let's say X amount of losses were paid out and Y amount of premium was taken in. There's a ratio there. Anything under 35%, they say that they're going to say is a profitable account. That's what they're going to say. Anything over 35%, and it's somewhere around there. It's not exactly 35%. Anything over 35%, they're going to start to debit the account. They're going to start to say, we need to add premium to this in order to get us closer to that 35% loss ratio. So everybody got me so far?
Yeah.
You like the inner workings, I know, but just stick with the concepts.
Makes sense. And sometimes, like you're saying, they may be increasing it on the building limit and what they're valuing that at, or it may just be an overall increase. Is that correct?
Yeah, I mean, there's a bunch of different ways that they're trying to get increase. They're trying to get increase on rate.
Right.
So rate is a calculation of how much are we going to charge for every $100 of building value. That's how they apply the rate. It's usually called a composite rate. Yeah. But if they say, all right, if I've got $20 million worth of building value, I'm going to apply a rate to that. For instance, in New Jersey, a really good rate is 15 cents. So $100,000, $100 million building at 15 cents. If you do the math, it's $150,000 in premium, right? 15-cent rate. So either way, that's how they do it. So one way to get premium is they're saying, well, I think I need to go to a 17-cent rate. So if the building value stays the same, the premium goes up because the rate changed. All right. The other way they get premium is they say, we're going to keep the rate where it is, 15 cents, but we're going to do it on $30 million of value, right? So they move it from the 20 million up to the 30 million. And that's how they get more premium. Now that 15 cents is based on the $20 million valuation.
Got it. Makes sense.
Yeah. Yeah. So one way to argue with the carriers in this situation, because at this point we're almost kind of at the carrier's whim, we're saying, well, what are you going to insure us for? What's the building value you're going to use? And the carrier says, we're going to use 30 million just because they say so, right? We can say all day long, well, we think we're 20 million. We can disagree with them, but it's up to, I mean, it's their word versus ours. And they're saying, well, we hold the insurance contract. So you either buy it or you don't, that's their stance. So in order to combat that, you kind of have to have some real hard data, and that comes in the form of an insurance appraisal. They cost a couple of bucks, but now you're in control. So that's something to think about.
And do you recommend those every 10 years? That's what I've heard, 5 years, 10 years.
Yeah, so those companies will usually do it the first year and then give you like 2 renewals for a small amount of money. So the first time you do it is maybe it's a few $1,000s, depending on the size of your community, a few $1,000s. And then the next year you get an update for $300. And then the year after you get another update. Once those updates are worn out, they're going to say, I want to charge you again.
Right.
Yeah, that's just that industry. However, with that report, there's no carrier that can say we disagree because they're not certified insurance appraisers. That's just one way to take the control out of the carrier's hands and say, this is a crazy market. We're gonna be in control. We're the board.
And are there any particular appraising companies that are recommended or?
Yeah, there's one that's all the time. Right, he works in Pennsylvania and New Jersey all the time. It's Industrial Appraisal.
Okay.
I've used them a lot. You know, other ones we've worked with in the past, but I feel like Industrial just gets it. They know community association insurance, so.
Yeah, that was part of my question too. Did they know, our industry? So
Yeah.
great.
Yeah, so I mean, I guess if I can leave you guys with one major concept here, is that we're in a crazy time, and crazy times require drastic measures. And by drastic measures, I mean, get together, make a plan, and put that plan into action. And that plan should really look like a formal, written down month by month, written service timeline. These are the services we're going to do, or these are the projects we're going to do month by month, and this is what's going to put us in our best insurable position, not for this year's renewal, but for the long term. Because at the end of the day, you're looking at paying for this big budget line item for a long time. So you want to make sure that you put yourself in the most insurable position. So really hold everybody's feet to the fire, hold your broker's feet to the fire. Hold the manager's feet to the fire, and really put that plan together, and trust the advisors to help you put together what you think might be what your community needs in terms of projects, services, etc.
Great. All right. Do we have any questions for Ryan thus far?
I guess, Ryan, I was going to ask, you were talking about how they're reducing coverages in an attempt to, keep the premiums down. Do they make it pretty clear to us, like we people who don't specialize in insurance, or did they just kind of does the broker kind of present it to us and hope we catch it or hope we miss it, or, are you spelling it out?
Yeah,
What
I
we're
like
missing.
this question. I like this question. So here's where I can shoot myself and all the brokers in the foot. You ready? So if they don't explain clearly that coverage has been reduced, their E&O carrier has to pay. So the broker's carrier has to pay. So if they didn't explain it to you clearly, and you've acknowledged that, yeah, I get it, and a claim happens where that gap in coverage would have covered, you can say, nah, broker, you're going to be on it now. All right.
Thank you. That makes sense. That feels good to know. Thank you.
Yeah.
Okay.
Here comes all the claims. Who else?
So just something, because we've had varied experiences with this, I think. I know the whole point of your presentation is to plan appropriately in advance, right? But let's just say, the association, the manager is sticking with the same broker. When is the time that we should expect the information by, with the renewal from the current carrier or any other carrier that they may have marketed to? What's a good time frame? Because I know we've probably seen anywhere from 5 days before renewal up until maybe 60, I would say, but generally nothing above 60 days. It's generally in that window. And I know a lot of it has to do with, you don't want to market anything out that's where you could have a claim within that period, I guess, but
yeah. So
average.
Yeah. So there's two different decisions each year that a board should make. One is, what carrier am I going to bind coverage with, insurance carrier? And the other one is, what broker do I trust to take me through this process for the long term? So those are two separate, this one thing that the industry doesn't really understand. Those are two separate decisions that can be made at any time. So typically what I'll say is, outside of the effective date, so without the live hand grenade with the pin out of it on the desk, let's take that out. The effective date is that explosion that, after that, coverage ceases and all hell can break loose. So outside of that hand grenade being on the desk, you get to do whatever you need to do in order to pick a broker that you believe is putting together the best plan of action that's going to make you the most insurable. And you want to see that plan of action. You want to meet the team. You want to understand exactly how you're going to be handled throughout the next 18 to 24 months, whatever it is. It's a long-term investment or a long-term relationship. So I would say that decision should be made 6, 7, 8 months before the effective date. You could bring them all in, every brokerage, you call them all up, you say, come in, we want to talk about how you intend to negotiate on our behalf. What carriers can you bring to the table, et cetera, et cetera, et cetera. Make that decision, believe in the plan that's on the table, understand exactly why you're running through that plan, and understand how it's going to make you more insurable, and then just go with it. Now, once that decision's made, then the process of marketing and negotiating with carriers, you should be pretty acutely involved in. And all throughout the process, you should be seeing these steps and stages. Okay, I see that we've gone to these whatever, 5, 6, 7 carriers. What are they saying about us initially? We usually call that initial carrier response. Are they saying mean things about us? Are they saying nice things about us? You should be involved in that conversation. What do they need to hear? What projects do they need to see us do? You need to be involved in that. Eventually, you get to a point where carriers are starting to entertain the association's insurance coverage. And at that point, you can start to say, I want to dictate when my date is. If you don't dictate when your date is that you want to bind that coverage, well, then you are, again, subject to whatever the broker and whatever the carrier wants to do. And if it's a big increase, and if it's a little bit of a sketchy renewal, I mean, I'm, again, shooting my industry in the foot, usually you'll get that pretty close to the effective date.
That's the 5-day out one, right?
Yeah, that's if it's an easy renewal and everything's great and there's a reduction and everything, guess what? You're going to get that as early as possible, right? So it's pretty obvious why things are late and why things are early. However, I think what boards and managers don't understand is that you can control that. You're the boss, and you can say it's on this day or we're not binding with you. If you say that and they don't meet it, there are carriers right behind them that are willing to price it probably pretty darn close. And if it costs you a couple $1,000s to move to another carrier that's going to be pliable and work with you and meet your deadlines, and come claim time, do the same thing, meet your deadlines, pay the claims the way you need them to be, well, isn't that worth moving to that other carrier that's more pliable? So I say take control. It's another area. You're the boss, and dictate.
That's a great point. I think generally, and I'm just speaking with the associations that I've seen, but generally it's the lowest is the best, but you make a great point with that. I did have another question on deductibles. So oftentimes certain associations will think that if they increase their deductible for, a property coverage and, maybe changing it to a per unit water deductible or something like that can significantly change the premiums. I've seen it vary kind of, I know it's dependent on the association itself, but do you suggest, the board looking into that as well with policies for any savings? Or
I do, yeah. So, deductibles are basically just a layer of protection for the policy. So the policy doesn't get involved in things below the deductible, right? Now, there is some premium savings that are involved there as well. However, usually raising the deductibles for a premium savings is not as big of an effect as is the clean loss history that the high deductible creates. So that's really what you're looking to do. You're looking to try to keep that loss history claim or that loss history clean so that you can enjoy that best in class rate we talked about earlier, that 15 cents for a long period of time. Because to go from 15 cents to 17 cents, that increase is far larger than any savings you have from moving the deductible around. Sometimes moving the deductible north is something that people have to do because of their claims. Sometimes you're doing it just to protect the policy. So it's either proactive or reactive. Either way, it should be something that you talk about each year.
Right. And it's also, from what I've been told, the change for the deductible increase to the homeowner's HO6 policy is usually very nominal. It's not, whereas, the savings you can get from either not having those claims in from the loss history benefits the association way more. So
yeah. And think about that. If your associations aren't making the association's deductible the responsibility of the unit owner, well, then we're missing the boat. That's
right.
Something that we should be doing 100% of the time. Think of the deductible as a hot potato. So the claim happens. The association is now sitting there with the hot potato that is the deductible, the board. So the board says, well, we don't want that because our budget's not prepared for it. So we're going to throw it over to the unit owner. Unit owner says, well, I don't want that because I don't have that much in my pocket. So they give it to their HO6 carrier. So it goes right back into the insurance industry and it's paid from a place it should be paid from.
Mhm. Great. Do we have any questions? Anyone?
Actually, I have one.
Great. Go ahead, Bob.
The question would be, how often should we or our broker shop us? Should we do it every year, or is it better to get with a carrier, try to build a relationship and stay for a while?
So I like this. I like this question too. Yeah. So Bob, I would say that it does depend on the market. When you're in that soft market and things are just, I mean, water falling down, I mean, then you're marketing aggressively. You're marketing aggressively because you're trying to capture all the savings you can on the way down. And then once you get to that bottom, that's when you start to make the plan to make it stick and say, all right, carrier, I rode this wave down with you. I appreciate that you got me to this bottom layer. Let's stick it out for a little while and build some rapport. When you're in a hard market, it does make a lot of sense to build some rapport with those carriers. You don't want to shop every year because the carriers, remember, they are developing what's called the loss ratio, right? So they're looking at that 5-year loss ratio. They're saying, how many premium dollars am I collecting and how many claims am I paying out? If you've got 1 year in there, the ratio could be blown up very quickly and very easily. If you've got 5 years in there, if you've got 10 years in there, see how hard it is for that ratio to change. And now you can enjoy that lower rate for a longer period of time. Does that make sense?
Absolutely. I appreciate that explanation. Yeah. Yes.
Anyone else? This has been really informative, Ryan. Any sort of final thoughts that you think we should have other than plan in advance, try to be proactive versus reactive? You gave us great data on, what's kind of, making the world a little bit crazy right now, especially with the insurance industry. And I think, we from the management end and also from the association end are seeing all of what you're talking about, materials delays, everything like that, just, internally with our specific associations already. So it definitely makes sense, as far as everything you're saying with the increases. And yeah, anything else, any other pearls of wisdom we can leave with this evening?
Yeah, the big thing I'll say is, have a plan on paper, formalized. The next thing is take control. You have the ability to do that. As much as you might think you're out of control, with a little bit of authority, don't let this industry bully you around. You do have the power to say, I want this and I want it on this date. So make some demands and hold some people's feet to the fire.
That's great. Sorry, one last thing I just thought of. We've seen in the past, sometimes if we're trying to get loss run history, where sometimes it may be delayed. Do you have any advice on, what could prompt getting that quicker? Because I know sometimes that can affect, if you're marketing the policies.
Right. So carriers in the state of New Jersey are required to give you those loss runs in 10 days.
Perfect.
If they don't, you can report them to the Department of Banking and Insurance. A lot of times the carrier will send the loss run to the broker and they will then be compliant. And then it's the broker that is kind of holding you hostage a little bit. So
Great.
I've done a lot of shooting brokers in the foot today, but listen, I'm kind of like the guy that exposes the magician for it's not actually being magic. So it is what it is.
We appreciate it. We won't tell.
Yeah.
All right. Well, thank you so much, Ryan. We really appreciate it. And thank you for everyone that attended this evening. It was a smaller, more intimate group, but I know you were able to answer a lot of our questions and it was really, really helpful. So thank you so much. And for anybody who's here, we'll have this recorded and we will also eventually have it posted to our YouTube page. So if any of your fellow board members may be interested, just reach out and I can send you the link.
Sounds like a plan.
All right. Thank you so much. Have a great evening. Bye.